Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, March the 17th, 2026. Okay, let's have a quick look. I just want to keep an eye on what's going on the Strait of Hormuz. We all know that oil is still driving sort of main markets. We have a lot of central bank activity happening basically over the next 2 or 3 days. But let's just have a quick look here. This is basically the daily crossings in the Strait of Hormuz bi-directional, so going in both directions. And what's kind of interesting is that obviously since the war began at the end of February, you can see that this has dropped from 60 or 70 tanker crossings every day. That's dropped down to essentially zero. Just a few sort of ships are still being able to pass through, but that has kind of stabilized. We're getting one or two ships starting to go through. So there's talk about some Pakistani ship. A tanker went through yesterday laden with about 2 million barrels of oil going to Pakistan. There's talks of negotiations allowing Indian sort of tankers with an India destination being able to go through. Obviously, the Iranian ships themselves, exporting maybe about 2 million barrels per day are going through. There's talks that maybe a few other countries. And so at this point, I just wondered, there was a little bit of optimism yesterday. There was some talk that the Iranian foreign minister had been in touch with the US Special Envoy Witkoff. The Iranians denied it, but Trump said they were kind of talking, but it was too early to do a deal, et cetera, et cetera. So it seems as though maybe behind the scenes we're slowly grinding towards some kind of sort of compromise. Obviously, politically, domestic politics for Trump, that is a necessary situation. Now, Trump is also trying to get together a coalition of countries who will help the US to sort of to provide convoys to help the tankers get through. There's still some ambiguity. Maybe France will help out the US. Obviously, Trump's talking about some local countries who might help. But on the other hand, there's been pushback from a lot of the European countries, from Italy, Spain, the UK, who have said, no, thanks, it's not our problem. Germany, it's not our problem. So the point is that, just stepping back, the state of play seems to be that there is some slight progress. We are maybe grinding towards some kind of compromise in a week or two or three. Certainly, Trump needs that from a domestic political standpoint. The Iranians don't seem in any particular mood to compromise at this point. Are they sending less missiles? Are they sending less drones? Yes. But at the end of the day, they still have a few missiles left. They can still disrupt shipping through the Strait of Hormuz with sort of pretty low cost drone attacks. So at this point, they're maybe just sort of settling back. We also know that the U.S. administration over the weekend hit the Karg Island oil export terminals and destroyed a lot of the infrastructure, the military infrastructure, but not the oil infrastructure. So very clearly, Trump is signaling that he doesn't really want to sort of do anything which will necessarily spike the price of oil. Although for me, the paradox is that probably the easiest way, if they genuinely want a regime change and sort of for big changes in Iran to bring down that sort of administration and government over there, would be to actually destroy their oil exports, Iran's oil exports capabilities, and cripple the economy. Now, would that cause a massive oil spike short term and a lot of pain? Yes. So that's probably unpalatable to the Trump administration and the American public as we come up to an elections. But in the absence of that, we'll probably get some kind of sort of messy sort of compromise. Trump will declare victory. But anyway, that's the state of the play with the Hormuz situation. Now, just in terms of central banks, I just want to go through and look and sort of see the bigger picture here. So, what's kind of interesting? Just got together sort of a bunch of charts here, and you can see here this is the five-year break even. And what I'm trying to do here is to understand. Okay, so we know that the price of oil has gone up, but we know that different central banks have different mandates. So let's keep in mind that, for example, the European Central Bank, they have only one mandate, which is inflation. So they, in a certain sense, at least from a mandate point of view, would be more obliged or obligated to hike interest rates because to combat inflation. Whereas, of course, in the US with the Fed, there are two mandates, which is also equally sort of to keep full employment as well as controlling price stability. Now we know that oil is going to lead through probably sort of higher inflation, although will it? That's probable. But on the other hand, we had the horrible non-farm payroll numbers, 5 or 6 days ago. And so the Fed is in this place where it's keeping an eye on inflation, but it also may not be able to hike very aggressively or want or need to hike aggressively because it needs to support the employment mandate. So anyway, let's just have a quick look and see what's going on. So if we take Brent crude, which is the most affected, so obviously in the black here we see the prices have gone up. But what's interesting is that the five-year inflation, if anything, has actually gone down a little bit. So keep in mind the five-year in inflation is essentially sort of saying, hey, 5 years from now, for the next 5 years, so kind of like medium term, where do we think inflation will be? Where the market thinks inflation will be. There's like inflation swaps and whatnot. And you can see that in general, it moves pretty much in lockstep with the price of oil. Even though it's meant to be sort of future looking, the reality is that, what's happening with oil currently feeds a lot into this. So we have a kind of a curious dislocation here that oil is ripping high, but the market seems to be saying, well, in the medium term, we don't think that's going to cause inflation. So why would that be? So clearly the two narratives at the moment are that there's going to be, number one, a relatively quick resolution to the war. And this is kind of what Trump is saying, and certain market commentators. The price of oil will collapse, inflation will come down, the economy will be sort of a blip in the US economy, and life will go on, and the Republicans will, win the US midterm elections. That's kind of one main market narrative. A second market narrative, which we see with charts like this, is saying, if this war continues to grind on for another few weeks or month or two, this has disrupted global oil flows so much that it's actually going to cause collateral damage medium term, which means maybe sort of like almost like a tax on the global economy with these inflated energy prices. That's going to cause a slowdown, maybe even a recession in the global economy. Maybe that's going to translate to a recession in the US, which of course is going to be deflationary. So ultimately, even though energy prices and oil prices are going up in the short term, ultimately that's going to cause maybe sort of a mild recession, or at least sort of a slowdown, which actually would be deflationary. And if you add into that potentially the deflationary effects of artificial intelligence and what's happening there, it means that medium term inflation expectations can remain sort of anchored, which is what we're seeing here. So that's really going to be the big battle, the big narrative in the markets, and that's going to have different implications. If you believe that AI is deflationary, there's going to be a slowdown in the US economy. That means that yields probably need to come down. So that would be sort of buying bonds. It means the US dollar would probably weaken, oil price would come down, and maybe equities. Well, that's a more complex situation, but you see, there's different kind of narratives. But anyway, moving on, we can then, you can just see, how all this is going to sort of affect central bank sort of thinking. So then if we go across and you say, well, okay, is this feeding into inflation expectations? And if we look at the 2-year and the 10-year tips, so that's Treasury inflation protected securities, which essentially is telling you what the market thinks about inflation. Again, you can see that in the 10-year, it's gone up a little bit, but if you actually look at the 2-year, curiously, the 2 years tips has actually gone down, which is essentially saying that there's not sort of massive concerns. And I think I showed a couple of charts earlier in the week, maybe yesterday, looking at inflation expectations. So it's like sort of short term, but over the medium term, it's not too high. Now, in terms of what this means for the Fed, we can see here this is the number of cuts. So sort of 25 basis point cuts are priced in, and obviously where we are now, we're around about one cut is still being priced in by the Fed, which is not the same for other central banks by the end of the year. And you can see here that obviously when the war started at the beginning of, or the end of February, beginning of March, you can see that at that point the market was pricing in about 2.5 cuts, and you can see that that's just been sort of diminished down to sort of one. Now, the question here is, if the war ends tomorrow, if the employment situation continues to worsen, we have wash coming in probably in May, will this sort of go up to maybe 2? That's going to be a very interesting trading possibility, but we need a little bit more information. And the other thing which is interesting, apart from IT, is that we've seen that energy importers have been very affected compared to, let's say, energy exporters. So you have countries like Canada, which is in a fairly good position in terms of energy, Australia, which is in a fairly good position in terms of energy. And you have, on the other hand, you have countries like Japan, Switzerland, the European Union, the United Kingdom, which are all sort of energy importers. And some of them have central banks with only an inflation mandate. They have had to react a lot more aggressively. So it's kind of interesting here to see just this is like a cumulative. So not the US. So what we have here is keep in mind that the gray is when the Iran war sort of erupted. So we have the European Central Bank, the Bank of England, Bank of Canada, and the Swiss National Bank. So what this chart is essentially saying, this from Bloomberg WIRP function, is essentially putting in all of the changes for these banks, and you can see here that for all of these central banks, the expectations of more aggressive monetary policy are really there, and you can see that we've gone from a sort of a relatively neutral sort of path up to a much more aggressive sort of hiking cycle. But what is interesting is that you can see here that where the changes have been driven, a lot of it's by the blue here, which is the ECB, the European Central Bank. You see a lot of that is pushing up. We also have the Swiss National Bank, because of course Switzerland is not exactly the world's, excuse me, greatest producer of oil or nat gas. So you can see here that in countries which are net energy importers, basically the market has repriced their central bank to be much more on the hiking cycle rather than worrying about sort of the hit to the economy. So that's an interesting one to be looking out for here. And then if you look at also, then the idea is that, hey, Angus, sort of central banks don't really they only look at core, they don't really look at energy, so we don't really need to worry about it. But the point is that central banks in general, if you look at historically, really, I was reading sort of Bob Elliott's article. If you look historically, going back to like even going back to the 70s and the Yom Kippur War and all this kind of thing, anytime we've had a major oil shock, central banks do not cut. They do not cut. At a minimum, they kind of historically sort of stay on hold, but generally they do hike a little bit. And that's just because what we have to monitor is at what point does all this energy prices actually start feeding into the core? So not only, sort of energy prices, but, just sort of general, let's say just sort of the general economy and causing inflation across the general economy. Now, probably with the Fed on Wednesday, so tomorrow, they'll probably say, hey, it's too early. We just look at core, we exclude food and energy because they're too volatile. We need more information, blah, blah, blah. But at a certain point, if this conflict continues to grind on for another 2, 3, 4 weeks, and every day, I was looking at some stuff this morning, every day, let's keep in mind that where the oil, the market is short of, 8, 10, 12 million barrels of oil every day. And we know that we have the strategic petroleum reserves feeding 2 or 3, 4 million barrels a day out into the oil market, but there's still a net deficit. And if we keep on going, as I said, for another 10, 20 days, that's just going to keep on tightening not only crude oil, but really what's more important here. You see here, you've got, gasoline prices, the retail gasoline prices in the pink are going up. You've got in the green here, you've got the sort of, what is the interesting color there? It's sort of like a mint green. Anyway, you've got the TTF nat gas for Europe prices going up. You've got the jet fuel. You see in Singapore, the jet fuel, the contract, the blue going up. Brent crude, of course, gasoline futures, et cetera, et cetera. So the point is that all across the energy spectrum, prices have gone up, and at a certain point, that's going to start bleeding into the core, which is going to create a general inflationary pressure. So even the Fed is going to be under pressure it's going to be under huge political pressure to cut from Trump. But it's going to be interesting to see if they're able to resist that and even start talking about holding or even hiking. And just in terms of the political pressure here, I think we all know this, but it's just interesting here, looking at Polymarket and Bloomberg data here, the probability of Democratic control of the House and the Senate, so both houses after the elections. You can see here, obviously, after the Iran attack, that was down at just under 40%, but getting up almost now to 50%. I think just on Polymarket, it's even over 50%. So this is a huge problem for Trump. And obviously, there's going to be internal pressures from other members of the Republican Party in the US, basically saying, hey, Mr. President, you do realize that essentially every week this goes on, our possibilities of losing not only the Senate, but also the House, and essentially back to the Democrats. And so this is a massive issue. So Trump will definitely be looking at this every day. And I think at this point, what we can say is that Trump will be looking for an off-ramp probably soon. He's starting to talk about, oh, we're getting a coalition together. Iran's finished. They have no more nuclear capabilities. There's no more targets to attack. So it seems to me that he's preparing the communication for a sort of a unilateral declaration of sort of cessation of hostilities. But remember, it takes two to tango. and that the Iranians maybe might just say, hey, we reserve the right to continue to harry, to harass, to attack occasionally shipping going through the Strait of Hormuz. And until and unless the Iranians also come out with some kind of statement saying, okay, we're stepping down as well, the oil market will be under pressure. So let's just have a quick look at a couple of markets here. Um, Yesterday was a little bit more of a sort of a risk-on day, so there was some positivity in the equities. But let's just have a look. Just talking about oil, obviously, have a quick look. It sold off a little bit yesterday. There was a sort of a pop and drop over the weekend, and it sold off. But we've subsequently seen just a little bit of sort of strength in the overnight session. And what I would say here is that the market, I don't believe the market can fall significantly more if we're still in a deficit of 4, 5, 6, 8 million barrels of oil per day. The market will want to see not only a unilateral declaration of victory and mission accomplished from the Americans, it will also need to see concrete evidence. Remember that chart at the beginning of the video that the Strait of Hormuz is operating correctly and and is functioning, and that tankers are getting through. We're getting up to 30, 40, 50 tankers going through and leaving every day. And also that the nat gas facilities in Qatar come back online, etc., etc. It wants to see a functioning oil market. And so I do believe that there's going to be headlines driving the price of oil. But I really can't see it getting, back down too much below 90 until those two conditions are met. So, Trump declaring an end, but also the Iranians on their side saying, okay, we give up as well, and let's just all get back to the pre-war situation. We're not there yet. Maybe we'll get there, in the next half hour or next week or two. But at this point, we're still up there. Okay, if we're looking at some other markets as well, we had the dollar yesterday selling off a little bit, showing just a little bit of weakness. I think also that was a bit of a technical level. You can see that the dollar index, it was at kind of a quadruple top here, just around about the 100 level, just above 100. So I think that is taking a bit of a technical pause, and also a little bit of optimism yesterday that Trump over the weekend didn't destroy the oil sort of processing facilities on Karg Island. But again, I think this is going to be dependent on what the markets have to say, and of course on the Fed tomorrow. Are they going to be sort of hawkish or not? We'll talk about that a bit more tomorrow. So the euro is essentially a mirror image of that. It showed a little bit of strength yesterday, but again, keep an eye on this very key levels at about 115. That's going to be the key. And what I do want to talk about is the Australian dollar. We had the Reserve Bank of Australia decision last night, and boom, they hiked interest rates. So they hiked at 25 basis points. That was relatively expected. The market had been pricing in about a 65% chance of a hike, so that was not unexpected. So they've gone now up to 4.1%. So this is one of the world's it's the first sort of major global central bank to actually start hiking. But there's a couple of nuances here. The decision was 5-4 to hike. So 4 out of the 9 members actually voted against hiking. So the market initially took that as being dovish, and you can see here the Aussie dollar, the Aussie dollar actually sold off a little bit initially. But Michelle Bullock, the governor, in the press conference afterwards, came out and said that the dissension in terms of the vote being 5-4, 4 against, was not so much the idea of hiking and the problem about and the necessity of hiking because of inflation. It was really the timing. Those 4 members had thought that maybe they should wait until the May meeting rather than yesterday. So and in the press conference, Michelle Bullock basically said that this wasn't necessarily or only related to oil. It was a much more sort of generalized inflation problem in Australia. Australia's domestic economy is doing quite well. The labor market's quite strong. And she basically said that, oil was one of the factors, but the actual underlying inflation was still way too sticky in Australia. And so the Aussie dollar is feeling a little bit of strength, but we'll see if this can push out of this range here. I think it may find it a little bit tricky unless there's a huge, a quick resolution and other sort of domestic factors to get above, let's say, the 71.5 level, just because there's 47 basis points of hikes. So another two hikes are priced in by the market for the end of 2026. So that's already quite hawkish. So you could say that there's, that they just hiked yesterday. The market's already pricing in almost 50 basis points of hike. So, as the Aussie, it's had a pretty good run. Maybe it's time just to sort of cool off a little bit. And it's still very, very sensitive to risk sentiment. Okay, just looking about some other markets here, just looking at the equities. And again, actually, I just want to look at the bond market here. So let's just look at the 10-year. It's a bit slow this morning, my trading view. Where's my chart? It's, hello. Let's wait for that to come up. My point being, just talking about the bonds, I don't know why that's not loading, but about the bonds is that, again, the yields have risen substantially. So you can see here that the ZN, this is the price, you can see that's gone down since the conflict. We had a little bit of strength yesterday, getting to some technical support. You can see around this levels here, 111.13. So that's obviously a very important level there. But the thing here is that if the market starts to perceive that, this conflict's going to end soon, Trump needs it to end from a domestic political point of view, the price of oil will come down, the price of energy will come down. But the US economy and the labor market remains weak, and we do get ADP weekly numbers today for the employment. Could it be that there could be a substantial rally here and the yields coming down, just as if the market believes that inflation will come down, not only because of energy coming down, but maybe sort of a bit of a slowing in the US economy. So that's an interesting level there, and maybe that is sort of the line in the sand down here, which I might actually just put a nick box on it. There we go. Just draw a nice little level there. So that's obviously a key level here. So that's going to be dependent a little bit on the oil situation and what the Fed has to say. But that definitely looks like a sort of a line in the sand just at the moment. Just in terms of the equities, just going to have a quick look at NASDAQ. The market is still trading very, very heavy here. So if we look at the ES, you can see here that if we just pop this onto a 4-hour chart, a little bit more granularity here, and let's say we do a fib, just a reversal here, you can see that in terms of what the bulls have done, even if we just go on the 4-hour chart to the 10th of March, which is only a week ago, I'm not even talking about, this level up here, up at over 7,000. But if we draw it's just that, you can see here that, the market is finding it even difficult. It was rejected twice at the 50% fib level, which is around about 67.80. And you can see at the moment, yesterday, okay, we had a sort of semi-positive price action, but we're still sort of struggling at this 38% fib from the short-term levels at about 67.52. So still very, very weak price action, and this is still trading very heavily. Now, yesterday, if we look at NASDAQ, there was, some relatively positive commentary from Jensen Huang, CEO, of course, of NVIDIA, talking about $1 trillion worth of sales over the next year for chips. So, he was sort of talking up NVIDIA, and, for sure, that's a very sort of positive story. So we saw NASDAQ had, pretty strong, a nice positive reaction yesterday. But the reality is that this equity market, from a technical perspective, is still trading very, very heavily. And if we get any sense from the Fed that they're starting to look at things through a more hawkish lens, and that the economy is starting to sort of just slow down, I do believe it's going to be kind of difficult to regain the highs, and we may even see a bit of a puke down below these levels here, down below 24,000. We shall see. If we just have a quick look at some of the underlying indices and just sort of overall situation, just to finish off here, if I can load this up. Why is this so slow? It's a bit sticky this morning, like inflation. Give me another few seconds. Apologies for the delay. Well, maybe I won't do that because that seems to be stuck. Apologies for that. Anyway. Okay, I'll leave it there. So as I say, let's keep on looking out for headlines, any sign that Trump is going to unilaterally declare victory. We also have the ADP. It's probably a tier 2 sort of data point, but just in terms of employment today, I'll be looking at those levels on the 10-year bonds just to see if the bond market is pricing in either sort of increasing inflation problems or whether it's starting to sniff out a weakening in the US economy and some kind of deflationary impulses. And of course, that's about it. Okay, guys, I'm going to leave it there. Have a great day trading, and I'll be back tomorrow with the macro snapshot. Thank you and take care.